Welcome to today's lecture in financial risk management. Last week we stopped here at the investment management with interest rate swaps. I tried to explain to you what futures and forwards are. I've shown you what a swap contract is, and you've seen and you'll probably remember that swap contracts are especially important in the context of interest rate risk management and also foreign exchange risk management, because there it's quite obvious that you can exchange, for example, constant interest rate payments versus variable payments, or one currency against the other one. Here on the next couple of slides, I just wanted to show you how these swaps can also be used, not just for hedging, but also for speculation. And it's quite simple that if you have a certain prognosis concerning the future time evolution of, say, an interest rate or the general level of interest rates, you can try to use this information and you can try to speculate. So first of all, of course, we're interested in hedging interest rate risk exposure, but we can also use it for speculative purposes, that is, for active risk interest rate management. Okay, so this is what we can do here. Now we are taking an asset swap as the basis for our for the next observations and for the next results. So we assume that we have a portfolio consisting of the following individual securities. We have fixed rate securities with a nominal value of N and a maturity T. That could also be a loan we've given out. Meaning that we have a fixed income product, a fixed income investment, and of course, as the interest rate payments on this investment are fixed, we are exposed to interest rate risk. Why? Because if interest rate change, then we could have made more or less money on the market, on the spot market. We are now expecting rising market interest rates, a very current problem, I would say, because interest rates cannot go any lower than they are right now. So we would expect interest rates to increase at some point in time. Maybe we don't know when, but we all hope that interest rates will rise to a normal level in the near future. We now want to hedge this portfolio with a pair swap, and the nominal value and the maturity should of course correspond to the notional value on our fixed income and fixed interest security. We assume that the nominal fixed interest rate and the swap rate for T years are the same, so that we have a swap contract at our disposal that exactly matches the details and characteristics of our fixed income investment. And then the hedging position simply corresponds to a variable bond, while the value of the hedged position is equal to the nominal value. And in reality, of course, losses expected from the interest rate fluctuations are substantially reduced. Okay. Now, what we could do for speculation in active interest rate management, we assume that an investor has invested an amount of capital at a fixed interest. Therefore, there's no direct interest rate here for the investor during changing market interest rates. However, we have opportunity costs. And we now assume an investor that has acquired an interest-bearing security with a 5% nominal interest rate and a 5-year term or 5-year maturity 2 years ago. If the investor expects rising market interest rates, he can take advantage of this interest opportunity by concluding a fixed floating swap with a maturity of 3 years. And this is shown on the next slide, still in German, but still. You have, for example, a financial institution A and an investor. The investor has bought a bond that pays out 5% fixed income. So we have 5% here. We are expecting interest rates to increase. So we are simply swapping the 5%, for example, for a variable Euribor interest rate. Now, the idea here is now quite simple. If you expect interest rates to increase, you try to get rid of the 5% fixed income and get a variable interest rate. And as soon as interest rates have increased enough, you'll do the opposite again, a second swap contract, and you will try to fix you will try to close this position and you will try to swap the variable interest rate back again to a fixed income that is, of course, higher than the initial 5%. And this is what is shown on the next couple of slides. You now assume that interest rates have risen to 7%, and then you will try to get a swap contract with 6 or 7%. And as a result, you will have made risk-free, more or less. Well, of course, it's risky because it's intertemporal, but at this point, this is a risk-free win and profit of 1%. So interest rates have increased again to 7%, and you can do a swap contract with 6%. This time we have the LIBOR, and we get the LIBOR for our 5 initial percent, and then later on we are swapping the variable LIBOR for 6% fixed. And in the end, we have a 1% interest profit that could be seen as arbitrage free or as an arbitrage profit, but one has to keep in mind that this plot here, this figure, shows actually 3 financial contracts at 3 different points in time. So if you were able to do this at the very same moment, this would be an arbitrage strategy and the profit would be risk-free. But as first of all you have to buy the bond, then do the first swap and then do the second one at 3 distinct points in time, this is not really risk-free. It is risky because in between we had the variable interest rate increase from 5 to 7%, and we were not sure that this were to happen. Okay. Now, if we instead expect falling market interest rates, we could do the same with a reverse floater. You might remember that a floater is something that pays out a variable interest rate. And what is a reverse floater? It doesn't pay out the variable interest rate V%. It could, for example, pay out 5% minus V%. And it has the opposite, exactly the opposite mechanism than a floater, a floating rate note. Okay. Then let the investor have an interest-bearing security with a nominal amount of N and a nominal interest rate of R1. We enter a swap contract, same nominal amount, but a variable interest rate in exchange for R2. And again, in the end, we can see that we have R1 plus R2 minus the variable interest rate payment, and we can do what is called an interest rate cap. What is that? A cap contract is the combination, more or less, of a swap, of 2 swaps. And you can see that, first of all, we have to construct the reverse floater. I have R1 here, and I get R2, and I have to pay out the variable interest rate. And in case of an interest cap, the buyer of this cap contract receives an interest rate of R% from the seller in return for payment of a percentage premium of the nominal value. And if a previously fixed interest rate, for example, the 6-month LIBOR, is below the cap, the buyer receives an interest rate of 0%. If the reference interest rate is above, the buyer receives the difference R minus the cap. So it's more or less like an option where you have a similar thing with binary options, for example. There also you have, well, it's not actually capped, but you have a fixed payment regardless of how far the underlying goes above or below the strike. And it's the same here. The payment the buyer receives is capped by this cap interest rate R cap. So in the example, the investor would have to purchase an interest rate cap with R1 plus R2 being the cap. And then you would get the following. This is an interest rate cap. We have a buyer and a seller here. You pay a premium, and what you get is the maximum out of 0% or the variable interest rate minus the cap, minus, for example, minus 2%, minus 3%. And then here, it's the reverse floater with an interest rate cap and a swap, you can see that we are paying out R at 1, we get a premium, we pay out the variable interest rate, and then we just exchange the premium paid to the financial institution 2, and we get the capped interest rate R. And in the end, you can see that even with decreasing and an expected decrease in interest rates, we can make, or we can try to make a profit. And this could be one possible strategy with interest rate swaps and caps and so on. You can also use all of these contracts, floaters, bonds, zero bonds, caps, swaps, etc., to synthetically construct other bonds, other more complex financial products. And this, in the end, is what we call structured finance or financial engineering. You take very simple, basic instruments, you combine them to generate any type of cash flow stream you want, and then you can try to sell it as a new financial product, and that is what investment banks usually do in trading and structured finance. Okay, so this can be part of financial engineering. For example, you can combine a loan and an interest rate swap, and I think by now you've understood what is meant with this. There is also a thing called a T+S forward swap. That is, the parties agree on a swap transaction that will take place in S periods and will have a maturity of T periods, meaning you do not start the swap right now, but you have actually not a swaption, but you have a forward contract on a swap, and it's called T+S forward swap because it will only start in, say, 5 years, and then the swap will run for another 3 years, and you will have a 5+3 forward swap. Now, this is just the combination of a forward contract based on a swap. Very simple, and the mechanism is exactly the same as a swap. No? Swaptions, combination of an option and a swap. You have the right but not the obligation to enter a swap contract, and of course the underlying is now, and the strike is a strike swap rate at which you can enter the swap, but you do not have to. The difference between the swaption and the forward swap being the forward swap has to be entered, and if you agree on a forward swap, you have to swap interest rates or currencies. In the swaption, you have the right but not the obligation to do so. Okay. And again, the construction is quite clear. You can have a look at these figures. And of course, with the swaption, you can distinguish and differentiate between a long pair swap, a short pair swap, and the hockey stick diagrams will look the same just as the options on stocks will look like. The difference being that the strike and the underlying quote and the underlying price is, of course, the swap rate. Okay, and short pair swaption and so on. Any questions concerning swaptions, forward swaps? I think this is quite simple, and we should spend a lot of time actually on the Black-Scholes-Merton model. Who of you has already learned a little bit about the the Black-Scholes-Merton model? Who has seen the Black-Scholes-Merton pricing formula, maybe in Professor Schumacher's lecture? Not even a single one, okay. Now, I take a lot of time to discuss this. Why? Because I think it's very important to understand the details and the mechanics of this model. It's a very basic for all of financial engineering and option pricing and so on, and actually risk management. Now, we've already seen what an option is. We've seen what plain vanilla put and a plain vanilla call is. Again, remember that if, for example, you are at time t, you know what a plain vanilla option is worth. If I ask you now, if you want to exercise a European plain vanilla call option, you would see that, for example, you have a strike of, say, 100, and you would see that you can call, for example, the stock of BMW. So this is the current stock price, BMW, and depending on this difference, you may either exercise the option or you will not exercise it. You will let it expire, and obviously you will do whatever maximizes your profit. So if this is a positive number, the difference is positive, you will exercise the option, otherwise you will let it expire and you will get a profit or loss of 0 unit. Now this is known at the maturity of the option. The problem is, what do we do here? What is C0, or for a put, what is P0? And you've already seen that the payoff and the payout profile of an option is nonlinear. The hockey stick diagram is nonlinear. It's a nonlinear function of the underlying price, and this is what makes it very difficult to come up with a pricing formula. I will try to guide you through this step by step. Hold your hand while I show you the mechanics and the mathematics of this. If you have any questions in between, just ask right now, because I think this is very important to understand how you can come up with this formula. The authors received a Nobel Prize for it, and I simply hate it, especially in German textbooks, when option pricing is done by simply showing the formula and telling you, learn it by heart. You don't need to understand it. And I will highlight why you need to actually understand the derivation of this model to see the beauty of it and why it can be applied to almost all types of options and not just plain vanilla options. Now the onset is that we want a model in continuous time that comes up with a pricing formula for options. And again, the basis for any type of pricing model is an arbitrage-free market. Now, if a market is in turmoil, we do not need to think about a pricing formula or asset pricing. If prices are off, there is no need for a model. If we're just going crazy, prices cannot be explained. But the basis for any type of asset pricing model is that markets should be in equilibrium and arbitrage-free. So supply equals demand, and the market should be arbitrage-free and usually complete, meaning that any type of cash flow can be generated by combining other financial instruments, and it is arbitrage-free, meaning the law of one price applies. So if you have two instruments, two financial contracts, two stocks, two derivatives, whatever, if you have two goods on the market with equal properties, there should only be one price if the goods are equal. This is the law of one price. If you can buy the stock here and you can buy the stock in the building next door, and here it costs 80 and there it costs 90, you will buy cheap and sell high, and by exploiting this price difference, you are acting as an arbitrageur, and this act of exploiting this arbitrage opportunity will force prices back into equilibrium. Now, what do we do? First of all, we need some idea of what prices look like, underlying prices. And the fundamental idea that Black-Scholes and Burton came up here is that they realized that the model, or actually that stock prices and the time evolution of stock prices resembles something that is known in mathematical physics. And this is a random walk. Now, to simply explain to you what a random walk in 2 dimensions is, you simply pick a point, a starting point, in 2 dimensions, so that would be in the plane here. You simply select a random direction, and the next step will be a step into a random direction with a random step length. So I would, for example, now choose this direction here and choose a random step length. Then again, starting from this point, a random direction with a random step length, now a little shorter step, and so on. And this is what we call random walk in 2 dimensions. In 1 dimension, it's quite clear, it can only go up or down. In 3 dimensions, it will be a 3-dimensional walk. Why is it called a random walk? Well, obviously, because direction and step length are random. It is also sometimes called a drunkard's walk, because as you might have guessed, if you walk into random directions with random step length, this is something you would usually do after drinking too much. This is a random walk. And the question now is, what does the end-to-end vector of such a random walk look like? We start here, for example, and then this direction, this. This could be a random walk. And now we are interested in properties of the end-to-end vector. And it's quite simple. First of all, the expected value of this end-to-end vector. The expected value is 0. Because if you choose a random direction and random length, in expectation you will get nowhere. Yeah? You take 1 step ahead and 1 step back. And in expectation, on average, you will get nowhere. Second of all, the length of this end-to-end vector in expectation is 0. Second of all, if you square those lengths, it will be proportional, on average, to n. So the square of the end-to-end vector is, on average, proportional to the number of steps of the random walk. This is a second property. The variance. Simply look at the known formula for the variance. The variance of the end-to-end vector, the length of this end-to-end vector, is given by the expectation of r squared, and again, this is proportional to n. This is quite interesting. Why? We will assume a random walk for stock prices. And you can see here that the variance of the end-to-end vector of a random walk is proportional to n, to the number of steps, aka the number of days you're looking at a stock price. And here it's quite interesting because you can see that the variance is proportional to n. And in many cases, if you take up especially a German textbook on risk management, you will see conversion formula for the value at risk. We've already talked about this. When a value at risk given on a daily basis needs to be converted to a value at risk on a 10-day basis or a weekly basis. And you will always find something like this, a square root of n, as a simple conversion rule to transform a 1-day var into a 10-day var or a 15-day var. Usually in these textbooks, there is no explanation given for why you're using square root of t. For example, square root of 10, square root of 14. The reason actually is, if you assume a random walk for the underlying price, for your stock, the variance of this step length vector is actually proportional to n. And this is where it comes into play if you want to transform it from a 1-day to a 5-day to a 10-day var. And it is interesting to note that usually it's never noted that it's due to the fact that you are assuming a random walk. That's one interesting thing. We want to assume a random walk. Now, actually this is due to the fact that a random walk shares a property that is called a self-similarity. What does it mean? If you have a random walk that looks like this, you can actually take this part here, okay, this here, and this vector is again a random walk in itself. And this is why it's called self-similarity. You can take any part of a random walk, and this part will again be a smaller random walk with the same properties. Now, next property. The end-to-end vector of a random walk is normally distributed with expected value 0 and variance b squared times n, where b squared is given by this sum. You don't need to memorize those parameters. You simply need to remember that the end-to-end vector, the length of the end-to-end vector of such a random walk is a normal distribution. It's normally distributed. And this is quite important. Why? In most textbooks, even the better ones, you will always find something. We are assuming a normal distribution for the log returns, for the returns of a stock. And this is true to a certain extent, but usually is not true when it comes to it's not really 100% formally correct. We are not assuming a normal distribution. We are assuming a random walk for the stock prices. And as a consequence of this assumption, this end-to-end vector here follows a normal distribution. We are not simply assuming a normal distribution for the prices. And this is important. So, by using a random walk, this implies a normal distribution of the associated end-to-end vector and thus the stock prices. Actually, the returns. Now, we want to model stock prices via a random walk. And we do this obviously in one dimension because the stock prices cannot go into two dimensions. It can only go up or down. So it will move on a straight line, up or down. Now we're assuming time elapses and the change in time is given by dt. We are assuming a change and a difference in time, and every time we see a d here, it means difference. So the difference between now, small t, and the maturity or some future point in time, capital T, this difference is given by dt times n steps. So 1, 2, 3, 4, 5, let's say 10 days, 10 times 1 day difference in time. The random walk is now to model the changes in the stock prices, that is, the change in the stock price DSI, SI minus SI minus 1. The change from the stock price from today to tomorrow. And again, DSI is the difference in the stock price, the change. Now, if the price itself were a random walk, the individual steps DSI would also be random walks because of the self-similarity of a random walk. However, a security with a price of 1,000 euros would then have the same price fluctuations as a security with a price of 10 euros. Therefore, we cannot model prices via a random walk. We have to model relative price changes with a random walk. If we were now to use the simple ratio SI divided by SI minus 1, it turns out that the end-to-end vector ST over S0 cannot be represented as a sum. But this is a prerequisite for the end-to-end vector to be again a random walk. Remember, if these are all vectors, if we start here and we go, if we have these steps here of our random walk, we have to see that the end-to-end vector needs to be represented as the sum of 1, 2, 3, 4 vectors. Simple linear algebra. If you have 2 points and you want to look at the vector that connects the 2 points, you can also take the sum of several other vectors that are connected to each other. And this is not the case here if we take SI over SI minus 1. Yeah? Is that clear? You need to, this needs to be true. As And you can easily see that this does not hold, because on the left-hand side you have st over s0, and on the right-hand side you have a sum, and this is not equal. But you can use log returns. If you take the log returns defined as the difference in the logarithmic prices, ln si minus ln si minus 1, and you interpret this as a random walk, this works. Because you might remember that the logarithm on the left-hand side is st over s0, and the logarithm of st over s0 can be written as the difference of the logarithmic arguments of this division. So this works, and this is one reason why we are usually working with log returns. It makes sense. In the end, if we are interested in a model that is working in continuous time, in stetiger Zeit, we should look at continuous variables and not discrete variables. And here we are using continuous returns, log returns, and we are assuming that the log returns follow a random walk. Okay, so this works. ln of st over s0 is this, and this is actually the sum of individual random walks, or end-to-end vectors. Okay. Next, we need a Veena process. A Veena process is a time constant stochastic process that has normally distributed independent increments. If a Veena process changes dt by an amount dw over time, these changes growth are normally distributed with expected value 0 and variance dt. First of all, who does not know what a stochastic process is? Ein stochastischer Prozess. Everyone's clear. Okay. You know what a random variable is? Yeah. Take a random variable, use an index t, and look at the set of all those random variables, and for each point in time you have a new random variable. They could be constant, they could be distributed under the same distribution, but the distribution could also change. And this is called a stochastic process. A set of random variables with an index set that usually mimics time. And now you can distinguish a discrete stochastic process from a continuous stochastic process. If, for example, t is element of the whole numbers, this is a discrete stochastic process. If it's in R, it's a continuous stochastic process. So you have infinitely small changes in time. Not just seconds, milliseconds, but it's infinitely small. A Veena process is a time constant stochastic process, usually continuous, that has to be normally distributed, independent increments. And this means what? All those are the change in this process. So this is the process Wt, meaning this is a set of random variables, and each variable Wt has a certain distribution, and increments are of course the change in Wt minus Wt minus I minus 1. And those increments, those increases or decreases, the changes in the stochastic process, those changes, dw, this is dw, those changes are normally distributed with expectation 0, and actually it looks like this. This is a very basic stochastic process. Actually one of the simplest one, I would say. A Veena process simply means you have a certain phenomenon that is modeled with a Veena process, and the random behavior follows a normal distribution with expectation 0, and variance being given by actually 1 times square root of dt. What does this mean? And we have to distinguish 3 things now. Random walk, Veena process, and what is called a Brownian motion. Does anyone know what a Brownian motion is? A Brownian motion is actually synonymous to a Veena process. However, the Brownian motion is the physical process and the physical phenomenon that can be modeled with a Veena process. If you take any type of liquid and you pour it into another liquid, the way it diffuses can be described as a diffusion process that is close to a Veena process. A Brownian motion is a type of movement of particles in space, and this random movement of a particle in a certain space, this is the Brownian motion. And the Brownian motion can be described with a Veena process. And it's quite clear, it's totally random, normal distribution, and 0 expectation. This is a Veena process. Again, in many cases, a Veena process is synonymously used with a Brownian motion, and also a random walk, which is also more or less a Brownian motion or a Veena process. But the fine distinction is that the stochastic process is called a Veena process, and the physical phenomenon is Brownian motion. Yeah, but you will also find in many textbooks a phrase like stock prices or log returns are modeled with a Brownian motion. And actually this is not 100% correct, because this is the phenomenon and it's not the model. The model is a Veena process. Same Veena process. Next, we consider an infinitesimally small change in time, dt, for the logarithmic prices d, l, and s. Under the assumption of random walk in constant time, the following holds: d, l, and st. The difference in the logarithmic prices, that is the log return, is if the prices are assumed to follow a random walk, then you can see that actually the log returns follow something that is sigma, a parameter sigma, times a Veena process. And that simply means that you are not taking a Veena process, but you have to slightly adjust the variance of the Veena process to get to this assumption that the prices follow, the logarithmic prices follow a random walk. And this is the first assumption you make. You have a Veena process times a parameter sigma. Sigma is, of course, already chosen. The notation is chosen to signal that this is a variance, that is a diffusion parameter. And under a random walk assumption, you will see that prices and returns follow a Veena process. Okay. Now this model could already be used in asset pricing, but problem is this model only has one parameter, the volatility sigma, and it's not very flexible. So what could you do? You include a deterministic trend. You include in this formula mu times dt plus sigma times dw. So we include a drift, and this is called a drift. Why? Because if you were only to use a random walk, it could look like this. And now, with a drift, you would get a trend into the model. Then you get something like this here. The log returns are modeled as a parameter mu times the change in time plus a volatility parameter times a very simple Veena process that more or less includes normally distributed increments. This first term here is deterministic. There is nothing stochastic about it. Mu is a parameter, and the change in time is deterministic. Always remember, although there seems to be, it looks like something stochastic, dt, you know that from today until tomorrow, the change will be 1 day. And this is known before. Okay. Again, the log returns. This will all follow a normal distribution. Okay. You can now extend this model by including non-constant drifts, volatility, stochastic volatility, stochastic volatilities that allow for jumps in prices and thus jumps in volatility. But this is the most basic form. Simply take a Veena process, multiply it with a volatility parameter, and add a constant deterministic drift. Actually, it might also be, you could also include a constant drift. This is not constant, but it's at least deterministic. And you have a model that includes 2 parameters. One, volatility or diffusion parameter, and 1 drift parameter. Why are we not calling it mean and variance? Well, if you want to estimate the mean and variance of the distributions, they are slightly different than mu and sigma. So to show that they are driving the mean and the variance, but are not exactly equal to the mean and variance of this process, you're calling it drift and diffusion, or drift and volatility. Note, if you assume a Brownian motion for the, I'm always confused with this. If you assume a Brownian motion for the returns, this means that you are assuming, if you are assuming a Brownian motion for the prices, this means that you are assuming a geometric Brownian motion for the returns, causing prices to be log normally distributed, whereas returns are normally distributed. And it might be on one of the following slides. It is definitely included in the computational finance master's set of slides. You will usually find something like this in a textbook. We are assuming a geometric Brownian motion or a Brownian motion for price and returns. Both are equivalent to each other. If you assume a Brownian motion for the prices and you take the logarithm, you will get a geometric Brownian motion and a normal distribution for returns and a log normal distribution for prices. So every time you see something like we are assuming log normally distributed prices or normally distributed returns, no, you are not. You are assuming, the assumption is a Brownian motion, aka a Veena process, or a geometric Brownian motion for prices and returns. And as a consequence, you will get normally and log normally distributed returns and prices. Now, this can be generalized in the following way. We have seen that in the basic form, we are assuming dst equals sigma times dw. A Veena process, very simple stochastic process, times a parameter sigma. Or we can say mu plus dt. Slightly more flexible, but still very simple. And now what we are doing next is, we are not using a constant parameter sigma and a constant parameter mu, but we are using a function a and a function b instead. It's the same idea, but we are including more flexibility when it comes to the diffusion and diffusion and the drift parameter. And this is the general basic form of what we call a diffusion process, Diffusionsprozess. And the name already hints at the physical phenomenon that is used to model it. Take a liquid, throw it into another liquid or another medium, and the way liquid A diffuses into liquid B can be described in physics or more accurately in mathematical physics by the use of the diffusion process. It shows you how, for example, if you throw milk into water, how liquid A will diffuse into the second liquid. That's why it's called diffusion process. A is the drift rate and B is the volatility. Might be constant, might be very simple, but at this point we are using a very general formula. Now, an important question is, if we have assumed, for example, a Brownian motion or a Veena process or a diffusion process for the stock price, which stochastic process a function f in S and t is following? So if we have a function f that depends on the stock price and the point in time t, how can we describe the stochastic behavior of this function f if we have assumed a diffusion process for S? And we are, of course, interested in a change df induced by a change ds. What is f? What is f supposed to be? Any idea? We are interested in a function in S, in the stock price. So what is f? Any idea? Yeah? Stock price? Yeah. No. S is the stock price. So what is a function f in S, in the stock price? Okay? The price of any derivative. In very general terms. S is the underlying. Again, remember why we are doing this. We are currently talking about option pricing. S is the underlying price. And F is the price formula, the price function for any derivative with S as its underlying. And this is the beauty of this whole model in the end. We will now show how you can calculate the price F regardless of what type of option we are looking at. And this is what makes me mad when I see those regular German textbooks on banking and risk management and this sort of thing. If it's written by a business professor and not by a mathematician, you will usually just see the end result. A pricing formula for a plain vanilla option, for a call, for a put, and you will be asked to learn it by heart. That doesn't make any sense because you're missing the main point of the Black-Scholes model. We can show the pricing formula and the whole framework without having ever talked about whether this is an option, whether this is any other type of derivative, whether this is a call, a put, a barrier option, an Asian option, or whatever. It's just a very general function, f in S and t. And up until the very latest point in this derivation of the model, we will see that it all works out nicely, but in the end, the last step is dependent on the type of option, and that's where it gets tricky. Now, next, we need what has become famous as Itoslemma. This looks quite difficult. Actually, it's not. We want to look at a change in the pricing function f, df. We are performing a Taylor transformation or a Taylor series expansion. Does everyone still remember the very basics of Taylor's theorem from calculus? Probably not. Who does not know? Okay. Take a function f of x. The Taylor's theorem states that if the function is continuous and differentiable in a point A, you can represent function f in this point in a, let's say you have a point A minus epsilon and A plus epsilon, there exists an environment of A that might be very small, but there is at least one set of points where this is true, so that F, regardless of how F looks like, can be represented as, and this is usually where I have to ask those math students that can give me the formula. I think it is I equal to 0 up until infinity, and then it's, oh, I think it's oh, I can't.
F dash f of I times, the function takes A divided by I factorial times x minus
Yeah.
raised to the power I.
Okay. Again, it's ith derivative of f.
Derivative of f
Yeah.
divided by I factorial.
Yes, and x minus a. Yeah, this is correct. Okay.
X minus A raised to the power I.
X minus?
A raised to the power I.
Ah, okay. Yeah. Okay. This is Taylor's theorem. Thanks. I keep forgetting it. I simply know what it means. It means that you don't know anything about function f, but Taylor's theorem states that if it is continuous and differentiable, there is at least a very tiny environment around a point A in which you can substitute function f via this series. And if you have a closer look at this series, you can see that actually, I think I have to evaluate the function at point A. Yeah. The first term here is a constant real number. And in the end, you can see that it's always just x minus a to the first, to the second squared, and so on. And it's a polynomial. And this is the very basis for approximation theory. It simply states that if a function is continuous and differentiable, you can substitute a function in a very small, tiny environment of a point A via a polynomial. So a polynomial is usually a very good function to approximate a continuous and differentiable function. And actually here, it's not an approximation, it's equal to the Taylor series. And what you can do is, you don't want to go up to infinity, so you're just saying, for example, 2 or 3. And the higher you go, the better your approximation will get. And you then call this a Taylor approximation in first order, second order, third order. And you are including more and more terms, approximation will get better. And here we're doing the same. It's a Taylor series expansion. So you are expanding the function as its Taylor series, and you're cutting off at one point because you're interested in a very good approximation, but not in this equal expansion. So DFS, as you can see above, this is given for a one-dimensional real function. In stochastic terms and in more dimension, it looks like this. You need the differential of this function. And what is it? It's the partial derivative of f with respect to s times ds plus the partial derivative with respect to time times dt. And then look at the formula above. You can see that then you need the second derivative and third derivative and so on. And this will continue until infinity. Okay. So we can write it in a slightly different manner. First derivative of f with respect to s, a plus b times dw plus first derivative with respect to time, dt plus 1/2 second derivative of f with respect to s squared, and so terms that all include dt times squared or dt raised to the third power, to the fourth power, and so on. And the idea now is dt is an infinitely small change in time. And if you square it, if you raise it to the third power, an infinitesimally small change in time will even be smaller and smaller again. So if we want to approximate this, simply leave out the rest. Every term that has dt squared, dt raised to the third power, to the fourth power, and so on, and this is left out. And we don't need to look at this. And then you see the following. The change, and I will from now on just refer to this as the change in the derivative price, df. The change in the price of derivative can be approximated via Itoslemma by first derivative times a plus b plus dw plus first derivative with respect to time dt plus 1/2 and so on and so on. And this here, now let's look at this more closely. We have dw squared in here, and the following applies. The expectation of dw squared is dt, and the variance is dt squared. Now, we have said that we don't want to look at anything that includes dt squared or above, meaning we are viewing it as 0. But then, if dt squared is 0, or assumed to be 0, this means that the variance of dw squared is 0, and if something has a variance of 0, it means it's deterministic. It's no longer stochastic. There's no stochastic behavior left in it. And if something is deterministic, we can simply reset it with the expectation. And dw squared then in linear approximation is just dt. It's the expected value. And together with ignoring all values below dt and setting dw equal to square root of dt, we get Itoslemma. And Itoslemma states, it's for those math students, it's not 100% precise, but it's totally sufficient for our purposes. It states that if you have a function f in a diffusion process, a change in the derivative price is given by la 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 dt plus la 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 dw, and this is again a diffusion process. So you can simplify Itoslemma to what? You have a stock price, diffusion process, then the change in any function in the stock price will also be a diffusion process, just the parameters will change. This is Itoslemma. Assume a diffusion process for the underlying, and you will get a diffusion process with slightly different parameters for the derivative price. Again, a diffusion process, and this is also called sometimes an Ito process, but diffusion is quite known. How do these parameters look like? Partial derivative mu plus partial derivative plus 1/2 times second partial derivative times sigma squared dt plus partial derivative times sigma times dw. And this is Itoslemma. It can actually be further reduced. You can see that instead of writing dw, you can write it in this way. The difference here is we do not have dw but ds, the underlying price again. And we can now derive the Black-Scholes price formula. Any questions so far? So far we haven't done much. We are simply assuming a stochastic process, a diffusion process for the underlying, and we know that the change in the derivative price is again a diffusion process just with different parameters. And you could have done the very same just by assuming ds equal to sigma dw. That is quite simple. Okay. Now we want to tackle the pricing, the value of an option. Let's say the value of a derivative, the price, at time t is given by v as a function of the underlying price and the current time. We assume that we have a stock price that is a diffusion process. We can write it in a slightly different manner with an average yield and an average volatility. And you can see now here that we have a parameter mu tilde times s, and also here s. And this is what? Does anyone know that? I think, please correct me if I'm wrong, I think this is a geometric Brownian motion, a GBB process. If you multiply this process itself, st, into the parameters, I think this is a geometric Brownian motion, in contrast to Brownian motion. Okay. Now, the price of the derivative is a function of the underlying price, and we can now describe the development, the time evolution of the price, simply by using Ito's lemma. So this is the new mu, and this is the mu volatility parameter. Now, again, this might sound quite strange. Why are we looking at a function f? The beauty of the whole model is that we do not make any assumptions on the type of derivative. The whole framework, the whole modeling framework works with any type of derivative. And we simply need to look at the changes in the price. Okay. And now, this is where it gets interesting from an economical perspective. We are looking at a portfolio that consists of a derivative, long, and a number of underlyings. And we now construct the following portfolio. We buy the derivative and we go short in the underlyings. The value of this portfolio changes according to d pi, the change in the portfolio price or value, is of course given by the change in the derivative price, dv, minus delta ds, the change in the underlying price times delta, the number of underlyings we've bought. So far we haven't talked about how many underlyings we are going short, but let's call it delta. We know that this is given by Itoslemma, la 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 dt plus la 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 ds minus delta times the change in the underlying price, so delta ds. Or simply switch it around, the change in the portfolio price is given by la 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 dt plus la 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 ds. Okay. And now we want to hedge this portfolio. We want to select the number of underlyings delta in order to make this risk-free. And how can we do this? It's risk-free when it is deterministic. And how can we make this portfolio change deterministic? Any idea? I will mark everything that is deterministic, and you will tell me what is deterministic. First of all, first derivative here, is it deterministic or stochastic? No, it's deterministic. Well, 1 over 2, obviously. Sigma squared. Stochastic, yeah. Could be stochastic. S squared, obviously stochastic. But it is all multiplied with the dt. So the whole first term is deterministic. How about the second term? It's times ds. And this one is stochastic. And it will become deterministic in case the second term vanishes. And when will it vanish? If this here is equal to 0. And then, of course, it's quite simple. Delta needs to be the partial derivative of the derivative price with respect to the underlying price. In this case, the portfolio is risk-free, and here, you know, who of you has taken the derivatives class, Professor Schumacher? No one? Oh, just one. This is why it's called a delta hedge. And this is why this partial derivative is called a delta, the option delta. The partial derivative of the option price with respect to the underlying price is called an option, the option delta. And why? Because if you buy delta amounts of the underlying, you will get risk-free portfolio. Go short, delta, underlines one option, and the resulting portfolio will be risk-free. And this is what we call a delta hedge. It's a perfect hedge because the resulting portfolio is risk-free. It's not just reduced, but it's completely eliminated. Of course, it's a sensitivity. It shows you how sensitive the option price is when the underlying price changes. Next, if the portfolio is risk-free, it means in an arbitrage, this is where arbitrage freeness comes in. If the market is arbitrage free, this portfolio, risk-free portfolio, should give you what? The risk-free rate of return. Again, so we are seeing that we have a risk-free interest rate R, and in case it's risk-free, the change in the portfolio value, d pi, should equal R times pi, the amount of money we've invested, times dt. And then simply substitute this. This is from Itoslemma, R pi dt. This has to be equal, otherwise the market is not arbitrage free. And then, if you combine this, and you simply bring it to the other side, so minus blah 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 equal to 0, you get the Black-Scholes differential equation. It's a partial stochastic differential equation, and it is the result we have for any type of derivative, for one derivative, and hedging a delta hedge portfolio with the delta underlines in a short position and a risk-free rate R, meaning that the return on a fully hedged delta hedge portfolio consisting of delta underlying short and one derivative long has to yield the risk-free rate of return given from the market. And this is the Black-Scholes, not the Black-Scholes formula, but the Black-Scholes differential equation. And it states that for arbitrage reason, return per time from a delta hedge portfolio must be equal to the return of a risk-free investment in the same amount of the portfolio value. That is quite clear. Now, what is a differential equation? We need to understand this in order to see what is going on. A differential equation, in German, Differentialgleichung. You probably have seen this if our math colleagues have come to this point in the mathematics for economics students? A differential equation is an equation in which a function and derivatives of this function are included. So the very simple example could, for example, be usually in differential equations we are not writing f of x, we are simply writing y of x or y. And a differential equation would, for example, be function equals its first derivative. This is a differential, a very simple linear differential equation. Gewöhnliche Differentialgleichung. What is the solution? First thing you need to know, it's not a number. It's a function.
Exponential function. The exponential function with the relative constant.
Yeah? The exponential function. So this is the solution. Is it the solution? Yeah? No. This is the second solution. Two things you need to remember. Differential equations do not have numbers as solutions, like equations, but differential equations have functions as solutions. And usually differential equations have a set, an infinite set of solutions. And you need to make stronger assumptions on this function to single out one unique solution. And for this differential equation, y equals the first derivative of y, you have infinite solutions, and two are quite clear. A constant function that is constant to 0, take the first derivative, 0 again, so y is equal to the first derivative, and the exponential function. Take the derivative, and again it's the exponential function. If you want to solve for differential equations, go to our math colleagues and take a class on differential equations. We don't do this here, and we don't need to do this. This here is a tricky one. It's a stochastic partial differential equation. It's stochastic because it has random variables in it, and it's a partial differential equation because it does not only have the first derivative, but it has partial derivatives in it. But we can see here that as this is an even more complex one, it will probably have a set of infinite set of equations and functions as a solution. An infinite set of functions. And we need to solve for it. And luckily, someone else has done this for us. Let's quickly recap the basic assumptions we've made. Underlying follows a log normal random walk, or in other words, a diffusion process. We have a risk-free interest rate. It's a function of time. The underlying does not pay out dividends. We haven't talked about dividends, so this is no problem here. Delta hedging is possible in continuous time. This is a tricky one because it means that you have no transaction costs and no arbitrage and no transaction costs. But still, the basic setting is very simple, and we do not need too strong assumptions. By the way, how do you solve this equation here, this differential equation? Quite simply, by, for example, saying y of 0 is 1. You make an additional assumption on a starting or an end value, and then you can single out one differential equation and one function as a solution of this differential equation. And here, what do you do now? You need boundary conditions, and this is where the type of derivative comes into play. You do not know the price today of the option, but you know how much it is worth at maturity. So you have the terminal value of the option, and this is the boundary condition you need, just like this here. This is the same with the option price and the Black-Scholes differential equation. This is how you make sure that out of all these infinite solutions, you get just one. And you need the type of derivative to make sure that this equation is solvable with a unique solution. Mach's nochmal auf Deutsch. Wir haben hier eine Differentialgleichung und Differentialgleichungen besitzen unendlich viele Lösungsmittel, unendlich viele Funktionen als Lösung. Und Sie müssen weitere Annahmen treffen, damit Sie eine Lösung, eine einzige Lösung bekommen. Und diese einzige Lösung dafür brauchen Sie eine Zusatzbedingung, eine Anfangs- oder eine Endwertbedingung. Und hier oben ist ganz klar, wenn ich da sage, ich habe hier zwei Möglichkeiten, die schon in Frage kommen, und ich sage dann y von 0 ist 1, dann ist es die Exponentialfunktion. Man kann es nicht die konstante Nullfunktion sagen. Und das gleiche machen Sie hier auch. Sie nehmen die Art des Derivats und für die jeweilige Derivat kennen Sie die Payoff-Funktion am Ende in der Fälligkeit. Und je nachdem, wie da die Funktion aussieht, setzen Sie die ein und dann können Sie die Differentialgleichung hoffentlich lösen und eindeutig lösen. Und this is what we do now. We are using the payout profile, P, as the final boundary condition here. And the Black-Scholes differential equation is equivalent to what is called in mathematical physics the heat equation. The heat equation shows you how heat wanders through a piece of metal. If you take a rod of metal and you start heating it up at one point, in mathematical physics you are interested in how the energy goes from one point where the rod is heated to the other part of the metal. And this is the heat equation, also sometimes referred to as the diffusion equation. And the solution of the Black-Scholes differential equation, depending on this payout profile P, is given by this term. And this is where mathematicians have helped us. This is the solution, and you can see it's not an analytical solution. It still depends on the payout profile, and it's given by this integral. This is the exact solution, but it's not analytical. And you can now start using any type of derivative, inserting the payout profile, and we'll start with a plain vanilla call, and then PS is the maximum of S minus K and 0. Insert it, so you have to substitute this here, insert the payout profile, and multiply it with the exponential function, divide it into the difference between two integrals, and do some clever math. We do not need this. And you will see this result. This is the famous Black-Scholes pricing formula for a plain vanilla, I think it's called, European call with no dividends under all these assumptions. And this is the final result. Actually, you now can see how suddenly the normal distribution comes into play here. This integral, together with the exponential function, this already looks very similar to the distribution function of a normal distribution. And this is why in the pricing formula here, you have function phi, the CDF, the cumulative distribution function of the normal distribution. This is where usually many textbooks start. Option price, take this formula. You need the interest rate, you need the current stock price, you need the strike, and simply take the formula, insert all the data, all the parameters, calculate the price, and you're done. Okay, this works. But you have no clue how actually the model is working. This is the analytical solution to the Black-Scholes differential equation that results from solving the heat equation, and that actually came from a delta-hedged, risk-free, arbitrage-free portfolio. Now, why am I showing you this? Again, you could have stopped here. Take this, and if you like mathematics, substitute P, the payout profile, and insert any payout profile for any derivative. and then try to solve for these integrals. And there's a very important distinction here. For very basic derivatives, you can come up with an analytical formula just like the one you've seen before. Then you have the Black-Scholes price formula. Actually, this is not correct. You have one Black-Scholes price formula. It is, of course, unique if you take, for example, a European call option or a put option, but it might happen that for more complex options and more complex derivatives, you cannot solve for this integral. And it is not possible to get a formula. You are still working in the Black-Scholes-Merton framework, but you cannot come up with a Black-Scholes formula because this differential equation has no solution. What can you do? You can, well, we'll look at that later on. You can do approximations. You can take the computer and let the computer work it out with different strategies. But this is where we differentiate between plain vanilla options and exotic options. Usually, plain vanilla are simple and you can come up with a solution here. Exotic ones don't have a solution. And you need different numerical methods to solve for this equation. And then, here, this is the pricing formula for a European call option. This is for a put. A digital call looks a little bit simpler. And again, if you cannot do this, you need more sophisticated methods. Yeah? And if you ever hear the Black-Scholes pricing formula, think of this model, think of its derivation, and remember that you can, in theory, price any derivative with Black-Scholes. And this is done in practice. You can price anything with Black-Scholes. The question simply is whether the Black-Scholes differential equation is solvable, whether you can come up with a solution and an analytical solution, but you can always try to approximate the solution via methods from computational finance. Okay, questions? Yeah?
Question regarding the random walk and the Veena process. So where exactly, so the random walk is the assumption or an assumptions which is used in the Veena process?
Yes, in the very basic form. You are assuming the random walk is more or less equivalent to a Brownian motion. And you are assuming prices to follow a Brownian motion, and that is again equivalent for log returns to follow a geometric Brownian motion, and that is the diffusion process I've shown you. That is mu, in the very basic form, it's yeah. This is the change in the price is given by mu s dt plus sigma s dwt. And if I'm not very much mistaken, this is a geometric Brownian motion. This is GBV. And then, of course, this here this is a diffusion process. This is a Brownian motion. By the way, if you are interested in knowing what our colleagues from the financial mathematics department are working on right now and what research is going on, using Black-Scholes framework, but substituting this process with more realistic ones. I've told you, you could have started with just dst equal to sigma times dwt. This is an even simpler process for the stock price evolution, but actually it's not very flexible. So researchers are now trying to substitute this process with more complex ones, with stochastic volatility, with jump diffusion, with stochastic drift terms, and so on. The difference is you substitute this process for dst, then you do Black-Scholes, you come up with a different differential equations, and our colleagues from the math department can calculate and try to solve for these equations. And if they come up with a solution, it's great. If not, They have to show how efficiently you can approximate this on a computer or even on a computing grid. But the framework is always the same. Assume a stochastic process for the underlying, use Itoslemma, a little bit of stochastic calculus, do delta hedging, use Black-Scholes-Merton, and look at a particular option with a particular derivative with a particular payout profile, and then see whether you can find an analytical solution to this problem. If not, use a computer. Any additional questions? As you will see, in every second exam here, there usually is a large 15-20 minutes question asking, explain in your own words the derivation of the Black-Scholes-Merton pricing model. And I'm not asking for any formula. It always helps to know the formula, but you need to know and you need to write down all those little steps you need to come up with the pricing formula. So you start with the stock prices and the log returns. You're assuming a diffusion process, a Brownian motion. Thus results the normal or log normal distribution of returns and prices. Then you are looking at a portfolio, option or derivative long, underlying short. You do delta hedging. You need Itoslemma that says that if you assume a diffusion process for the underlying, you again get a diffusion process with slightly different parameters. Then substitute in this equation for a portfolio value, substitute ds via the diffusion process. Use Itoslemma, and so on, and so on. And in the end, you get a differential equation. You need an additional condition to solve for the unique solution for this differential equation. And in case you have a plain vanilla option, you will get an analytical formula. Has been, as I said, part of every second exam by now, because this is very, very fundamental thing to understand. Okay. Also, one final note, why is it called Black-Scholes-Merton? Because Black and Scholes showed this for stocks and stock options, and Merton, who actually visited Leipzig University, I think 2 or 3 years ago, he came up with a basic, actually the same idea, just with a totally different application. Does one know which application he used? He had a different application. Maybe one knows this. It results in something now that is famous called distance to default, Merton's distance to default. And is what? FV stands for firm value, D stands for debt. And what could this be? The difference of the firm value minus debt, or 0, and the maximum value of this. What could this be? It looks pretty much like a call option with the firm value as the underlying and the debt as the strike. And what is this? Any idea? Yeah, Svenja? Say it out loud. Equity, exactly. It's the market value of equity. What are shareholders getting? They get the firm value, and first they have to pay out debt holders. And if the company has not enough firm value left or asset value left to pay out all debt holders, the company is bankrupt and they will get 0. And the maximum of firm value minus debt and or 0, this is the market value of equity. And Merton came up with the idea that the market value of equity and the market value of debt can be viewed as options. And if you look at this in this way, you can calculate the distance to default, the default probability, and many other interesting things that are due to Black-Scholes-Merton model. For example, if you have ever wondered why stockholders and bondholders have different interests in the company taking on risk, it's quite clear from this view. If you know that the market value of equity is a call option on the firm value, and if you know that actually for debt holders it looks the other way around, you can see from the Black-Scholes-Merton model that actually bondholders and equity holders have a different interest in volatility of the underlying firm value going up or down, especially when the option is at the money. And this is a very, very good theoretical explanation of what we call, how is it called? Gambling for resurrection. If your company is close to bankruptcy, equity holders have already lost everything. Their option is worth nothing. And the only thing they can do to drive the option value into the money is to drive volatility up. That is gambling, speculating, and forcing managers to drive up risk. Bondholders are not interested in that. And this is why, for example, shareholders will be interested in a company taking on additional risk in case it's almost close to bankruptcy, whereas bondholders are not interested in volatility. They are not profiting from high risk. And this is an area that is very, very interesting, part of corporate finance. And because he came up with basically the same idea with a totally different application, it should be called the Black-Scholes-Merton model. Usually it's just called the Black-Scholes model. But Merton also received the Nobel Prize for this. No? Okay, any questions? If not, thank you for your attention and see you next week.